Hello everyone, welcome to the Dividend Portfolio channel. Today I'm really excited to share some of the research I've done on Walgreens. Now, Walgreens is a dividend aristocrat that recently has seen a significant increase in its dividend yield due to a declining share price. And kind of one of the things I always look for when I'm looking at investments are, really good, solid dividend-paying companies that have abnormally higher dividend yield. So I was very excited to take a closer look at Walgreens here. So let's jump right into it. So let's take a look at the core background of the business here. Essentially, Walgreens is a major retailer and wholesale pharmacy involved in distributing medicine as well as health and beauty products to millions of customers worldwide. In fact, currently, as of now, Walmart has distributed their products to over 21,000 stores in over 25 countries. And they provide a number of products through 250,000 doctors, pharmacists, health centers, and hospitals annually. In fact, Walgreens is actually the largest retail pharmacy in the United States and Europe. And this is reflected by the fact that nearly 78% of their customers in the United States actually live within a 5-mile radius of either a Walgreens or a Duane Reade retail pharmacy. So this goes just going to show you just how big and influential the company has become. Looking at the financial history of the company, we can see that Walgreens has had pretty solid growth of revenue over the last 5 years. So in fact, we can see that Walgreens, here shaded in green, has seen about 3.81% growth in revenue on a compounded basis over the last 5 years. And a good part of this came from their expansion of their distribution centers and stores. So Walgreens actually purchased a number of distribution centers, approximately 3, and nearly 2,000 stores from Rite Aid. So that's RAD here, Rite Aid. And this is help fuel this top line growth here. Additionally, these purchases were made from Rite Aid for about $4.4 billion. Looking at some other financial metrics, we can also see that this has come with a good amount of increase of debt. So Walgreens has significantly increased their long-term debt over the last 5 years. And this is also reflected with a low current ratio. And this is even lower than other companies, other competitors like we have Rite Aid here, we have CVS underneath, and of course Walmart. Now with Walmart, there's obviously more to Walmart than just their pharmacy division, but it still allows for a comparison between Walgreens and some of their competitors. And just kind of seeing in here, so we see this increased debt, we see this lower debt ratio than some of the other competing companies. Due to the global healthcare crisis, Walgreens has actually had reduced hours and reduced customer traffic during a good part of the 2020 year. This has actually led to a negative net income. So the net income is actually negative over the last trailing 12 months, so they don't actually have a compound annual growth rate for that. Looking at free cash flow here, we can see that once again the company is, because of these challenges, has really dropped significantly in free cash flow. And so, kind of comparing that to, Rite Aid's very similar. They had a similar amount of revenue growth, similar declines in free cash flow and net income. They're both negative. And the 5-year total debt has been slower growing for Rite Aid, but that's also due in part to these acquisitions that Walgreens was making on Rite Aid. Correspondingly, very interestingly, I think here, is that CVS has actually seen very strong revenue growth over the last 5 years. There's very solid free cash flow and net income growth, but their total debt growth has been much higher than Walgreens. However, their current ratio is still better than Walgreens. So I found this to be actually very interesting when comparing these companies. I also took a look at the company's efficiencies. So in this situation, I was looking at specifically their gross margins and their profit margins. And we can see that, between Walgreens, Rite Aid, and CVS, that they have similar gross margins. Walmart has quite a bit higher due to the nature of the services they provide. Furthermore, one thing that I found interesting was that Walgreens currently has a negative profit margin. So this goes back to the fact that they're currently not making any net income, as we saw in the previous slide. And this is also a little bit better than Rite Aid, which is actually losing more money currently. But CVS at the moment is actually still generating reasonably good profit margins here, which is in line with Walmart. So I found that to be very interesting, and that's something to keep in mind with Walgreens. So now I was actually interested in the company's growth prospects. So I was looking at some of the annual estimate EPS growth over the next 2 years. And in fact, Walgreens has by far the most expected growth out of these 4 companies. And we can just see here that the company has about 7.5% to 8% expected growth here, whereas Rite Aid is expecting significant declines in EPS as they are selling some of their stores. And CVS and Walmart have similar expected growth of about 5%. So let's take a look at where this expected growth for Walgreens is predicted to come from. And I'd say a large part of this growth is expected to come from their increase in the number of stores and locations. Now, Walgreens has entered into an agreement with VillageMD to invest about $1 billion to open between 500 to 700 Village Medical at Walgreens over the next few years across 30 U.S. markets. In this situation, Walgreens is expected to hold about 30% ownership of these stores. Additionally, Walgreens is also working with McKesson Corporation to combine their pharmaceutical wholesale business. And this is through their operations in Germany, which they expect that Walgreens will have about 70% controlling interest, and that this will increase the business efficiency of these stores. Furthermore, Walgreens is also working on their e-commerce platform. So this platform is designed to help them compete with Amazon, which is recently has become a competitor in the retail pharmaceutical space. And we'll discuss that a little bit more later. But essentially, this platform here is going to help integrate. The idea is to help integrate the business and help keep and retain customers to the services. Additionally, the company has undergone massive cost-cutting and efficiency increase initiatives. The plan for Walgreens is that they want to cut nearly $2 billion in cost by 2022. And so as we saw with the previous slide with the margins, significantly cutting these costs will help improve this profit margin that we saw above. And hopefully this will really help the company, especially in this low margin industry in the retail pharmaceutical. Now, let's take a look at the valuation of Walgreens. We started with taking a look at the forward PE ratio. Now, this is the idea of how much the forward price to earnings is currently predicted for the company. And we can see that for Walgreens, it has a very appealing forward PE ratio. So currently, this forward PE is a little less than 10. And if you look from the historical perspective, here it is quite a bit lower than its historical average over the last 5 years. Furthermore, the forward price to free cash flow here, so the component over here, we can essentially see that Walgreens is at, once again, price to free cash flow above this 10, and this is still significantly below its 10-year median price to free cash flow. So we can see that on both these ratios, they're below 10, and they're quite a bit lower than their historical average. Interestingly, looking at CVS, we can see a very similar story at the forward PE ratio. And interestingly, for the price to free cash flow, CVS is a little bit better valued, having a similar median price to free cash flow over the last 10 years, but an even lower forward price to free cash flow. And interestingly, when you kind of look at Walmart, you see the opposite, where the forward PE ratio is above its average and the price to free cash flow is still above its average. We also took a look here at the forward adjusted PEG. So we look at the PEG ratio immediately expected next year, and then also over the next 5 years. And we can see that Walmart is doing really well with immediate forward PEG. So in the short term, there's significant growth expected for this company. Over the long term, currently, there is not so much growth expected. So it has a very high 5-year PEG. This is kind of indicative of, in my opinion, more of a recovery. So Walgreens is very likely to expect to see a good recovery, in the next year or two. Whereas, going that is probably going to go back to a more slow-growing, company. Now, CVS is in a similar situation, has a slightly higher forward PEG ratio, but the 5-year is actually quite a bit better than Walgreens. And Walmart here, we can see it has a higher immediate PEG ratio, but 5 years out, it's very similar. Additionally, looking at price to book ratio, we can see that Walgreens is a little bit lower than their historical, but CVS is a little bit, it's in a very similar situation, I would say, as Walgreens, and Walmart is has a significantly higher price to book than its 5-year average. So with that, let's take a look at the dividend for these companies. And so what I really like about Walgreens is its dividend yield. It has an almost 4% dividend yield. And you compare that to the median dividend yield of this company, we can see that this 4% is almost double its 10-year median dividend yield. Additionally, I was very impressed with this 5-year dividend growth rate. So this growth rate of about 11.84% is really good, especially for a company as large and as developed as Walgreens. I was also going to say here that 43 years of dividend growth rate is also excellent, which, if they can keep this up for another 7 years, they're hopefully going to become a dividend king. I would say the things I didn't like about this here is that the expected growth rate over the next 2 years is expected to slow down significantly. So they're going from like 11.84% to a little under 3%. And their credit rating is probably the weakest out of these 4 companies here. I'll also point out some things with CVS here. The dividend yield is much lower for CVS than Walgreens at the moment, but it's still about double its historical 10-year median dividend. Its 5-year dividend growth rate is quite a bit lower than Walgreens, and part of this is that they haven't raised a dividend in the last year or two. But their expected dividend growth rate is quite a bit higher, and additionally, their credit rating is a little bit better. Finally, I'll point out that Walmart has a 1.49% dividend yield, so it's below its historical median, and it had slow growth, which is expected to increase somewhat in the next few years. They have a great dividend growth history here, and they have a wonderful credit rating. So I also looked at the dividend payout ratio and the interest coverage to get kind of an idea of the safety of the dividend. And so we can see with the dividend payout ratio is that Walgreens and Walmart have very similar dividend payout ratios, very reasonable, under 40% on an adjusted basis, whereas CVS has a little bit better dividend payout ratio here in the 26-27% range. We looked at the interest coverage ratio, which is the ability of the company to cover their immediate interest obligations. And we can see here that Walgreens has an interest coverage ratio of under 2. So typically I like seeing companies with at least a 2 or above. So this is lower, and that's something important to keep an eye on. Whereas CVS has pretty solid coverage of their interest, and Walmart has, fantastic interest coverage. Finally, I'll sum up here with some of the risks associated with the company. So essentially, the retail and wholesale pharmacies do operate in a competitive, dynamic, and low-margin industry. In particular, Walgreens experiences a number of reimbursement pricing pressures from different health organizations, governments, and companies. So there's a lot of power from these groups that can essentially renegotiate, terminate, or have expiring contracts, which can limit the amount of revenue generated from the sales of their pharmaceuticals. Furthermore, we discussed this earlier, but the global healthcare crisis has been very hard on Walgreens. So there has been a significant decrease in the operation hours and customer traffic across the globe. This can also be exacerbated by future lockdowns across the globe. So finally, Amazon has also recently become a competitor due to their acquisition of PillPack. And so this acquisition really allowed them to expand into the prescription drug market. And obviously, due to the presence and popularity of Amazon, this has really kind of created a challenge for Walgreens really to step up and provide their own online convenient platforms to compete with Amazon. All right, just kind of to wrap up here, I want to provide some final thoughts about Walgreens. And I understand, and I agree with the management's long-term perspective that the outlook for pharmaceutical wholesalers, which includes Walgreens, is actually quite positive. The general life expectancy has been increasing over the last 100 years. The development of new therapeutics from various other therapeutic companies, which I've covered a few in this channel, and the increasing insurance coverage for prescription drugs should indeed help the long-term outlook for pharmaceutical wholesalers like Walgreens. Furthermore, the company does have a plan to kind of promote recovery following this global healthcare crisis. We saw that with kind of the financial returns over the last 5 years and the current different margins. We can see that the company was really hurt by this global healthcare crisis. So the company does have a plan to actually recover, and it also has a plan to continue to promote and expand new stores, locations, and platforms, along with cost-cutting measures that really should help the company be in a better situation going forward. Finally, I'd say that the valuation of the company is actually quite appealing. In today's market, it can be very difficult to find value. And so when a company like Walgreens has a forward price to earnings and a forward price to free cash flow below 10, this is, I think, potentially an appealing valuation here. Furthermore, the company also has a dividend yield well above its historical 10-year dividend yield. And taking that with the fact it's a dividend aristocrat that has raised its dividend for the last 43 years and has experience dealing with economic downturns, this actually makes Walgreens a potentially appealing dividend investment. I was also very impressed with CVS, which also did well on many of the metrics, although it did freeze their dividend over the last few years. I think that CVS also might warrant a closer look. So currently where I'm standing on this is Walgreens is definitely on my watch list. I would like to see a little bit of an improvement in some of the margins and some of the returns before starting an initiative, but I'm certainly caught my interest here, and I will be keeping a close eye on Walgreens moving forward. So that summarizes my research on Walgreens. I hope you did enjoy this video. I would really appreciate a subscription and a like. Kind of to share some disclaimers, I am not a financial advisor. This is not financial advice. I am sharing my financial journey for fun and entertainment purposes only. Models and graphs are not guaranteed to be accurate, although I do my best. And of course, please consult a financial advisor and do your due diligence prior to investing.